In 1998, two Nobel laureates and the smartest bond trader on Wall Street lost $4.6 billion in 4 months. The math did not fail them. Their assumption about the math failed them. In 2026, AI quant funds run on the same assumption, and the IMF just warned about it. The fund was called Long-Term Capital Management. John Meriwether, the former head of bond trading at Salomon Brothers, ran it. Myron Scholes and Robert Merton, who won the Nobel Prize in Economics in 1997, signed off on the math. Their flagship trade was simple. New Treasury bonds trade at a premium because they are liquid. Older bonds, just a few months off the run, trade at a discount. The spread between them was vanishingly small, sometimes a fraction of a basis point. So they bet the spread would converge. And for 4 years, it did. To turn a fraction of a basis point into a real return, you need leverage. Brutal leverage. On $4.7 billion of equity, they borrowed over $124 billion. On top of that, they ran an off-balance sheet derivatives book with a notional value of $1.25 trillion. 25-to-1 balance sheet leverage, zero collateral required, because every major bank on Wall Street wanted their clearing business. August 17, 1998. Russia defaults on its sovereign debt and devalues the ruble. The world stops caring about cheap bonds and runs for the most liquid asset on the planet, on-the-run U.S. Treasuries. LTCM's trade was the exact opposite of where the money was going. Spreads did not converge. They exploded. On August 21st alone, the fund lost $553 million in a single day. Their model said this was statistically impossible. Here is the math that broke them: value at risk, or VAR. A formula that takes the average return, the volatility, and a confidence level, and tells you the worst loss you should ever see. At 99% confidence, LTCM's model said the daily loss would rarely exceed $35 million. The formula has 3 hidden assumptions. 1. Returns follow a normal bell curve. They do not. Real markets have fat tails. 2. Correlations between assets are stable. They are not. In a panic, every correlation snaps to 1. 3. You can always sell at the market price. You cannot. When you are the market, your own selling moves the price against you. LTCM had positions across U.S. Treasuries, European swaps, Japanese yields, mortgage bonds, merger arbitrage, and emerging market debt. On paper, perfectly diversified. In the panic of August 1998, every single one of those positions started losing money on the same day, for the same reason. The diversified portfolio became one giant bet on the world staying calm. September 23, 1998. Warren Buffett offers $250 million to buy the entire portfolio. 45-minute deadline. The offer collapses on legal technicalities. That same evening, the Federal Reserve forces 14 banks to inject $3.625 billion in emergency capital. Bear Stearns refuses to join. 28 years later, they would not be around to refuse anything. That was 1998. The math did not go away. It got automated. Today, systematic algorithm-driven trading is over 75% of U.S. equity volume. The quant fund industry manages $1.32 trillion and is projected to more than double by 2034. The simple VAR formula has been replaced by GARCH models for dynamic volatility, hidden Markov regime detection, and deep reinforcement learning agents trained on decades of historical data. And it has already failed. Multiple times. August 2007, the Quant Quake. Crowded equity factors unwound across funds that did not know they shared the same trade. March 2020, the COVID crash. VAR-based risk limits triggered synchronized liquidation across the industry in days. August 5, 2024, the Bank of Japan raised rates by a quarter point, and the yen carry trade unwound so fast the VIX spiked above 65. October 10, 2025, a crypto liquidation cascade wiped out billions in open interest in minutes, and the AI execution algorithms trained on calm markets simply froze. There is one new failure mode that LTCM did not have. In 1998, every risk desk on Wall Street used a similar version of the same VAR equation. In 2026, thousands of supposedly independent trading firms are building their models on top of a handful of shared AI foundation models and data aggregators. The math is no longer in spreadsheets across the industry. The math lives in 3 or 4 places. If those signals are wrong, everyone gets the wrong signal at the same time. This is not a hypothetical. In April 2026, the IMF Managing Director, Kristalina Georgieva, publicly warned, quote, "We need guardrails to protect financial stability in a world of AI," end quote. Former SEC Chairman Gary Gensler put it more bluntly. A base model or data aggregator may send a similar signal to many individual actors, leading them to make similar decisions. Such monocultures are the classic problem that leads to systemic risk. I may play a central role in the after-action reports of a future financial crisis. Long-term capital did not crash because its models were wrong. It crashed because the entire industry trusted the same model at the same time, and the world did something the model had never seen. The next failure will not arrive at the speed of margin calls over the telephone. It will arrive in milliseconds, coordinated by the silent signals of a few shared AI models. Subscribe so you don't miss the next one.